So let me ask y'all some questions and y'all can test yourself here a little bit. So, and y'all jump in if you have the answer. What does parsimony mean? Can someone explain that and talk about parsimony without looking at your notes?
Be stingy.
Being stingy. So what does it have to do with investing?
Getting enough information that you can make informed risk-averse decisions, but without wasting resources and time and effort and money.
Yeah, very good. Was that Zach? Yeah, that's good. Yeah, I don't know if y'all understand the resource issue, but yeah, it's if you do non-US REIT stocks, we actually looked at it as an asset class, and you decide to add it, that's going to add several hours to your workload to go out and interview those managers. So you don't want to add asset classes if you don't need them. All right, anybody know what duration is? Have y'all heard duration before this class? I'll say, Luis, I think we mentioned it in our 3013 class, but do y'all know duration?
I believe we did.
So you're in an interview and they bring up the concept of duration. What would you say? What does duration measure? What is it?
Duration measures how long until the bond matures.
Okay, and your weights are what? So the cash flows of the bond with the weights of what? Anybody know? So if the maturity is 10 years, what do you think the duration would be? Let's say you have a 10-year treasury and interest rates are really low now. So if you think about it, there's an intuition on the CFA exam, they asked this. There's an intuition, interest rates are really low. So you're using weights. What are your weights? Or weights are what? Discounted cash flows, right? What happens when interest rates are really low to that 10th year return of the principal? If your discount rate's 1% versus 5%, what happens to the present value of that $1,000 you get back in 10 years? It's going to be lower or higher at 1%. The lower discount rate, what happens the 10th year out? Much higher, right? If you discount $1,000 for 10 years at 1%, you're going to get a much higher number than if you discount it at 5%, right? Y'all remember that from 3013? So that means that 10th year cash flow has a lot more weight when interest rates are low than when they're high. So that means when interest rates low, durations will be higher, right? So the 10-year treasury today, I don't know what it is, I should calculate it. But the 10-year treasury today, interest rates are really low, right? Everybody understands that, 0.6%. We haven't been below 1% ever in the history until this year. Interest rates are really low, so if the maturity of the 10-year treasury is 10 years, then the duration would be what? 11 years, 9 years, or 7 years? It's probably one of those three. What would you think? 11, 9, or 7?
Wait, may you repeat the question again?
Okay, so let me type it out and I'll show it to you. Boy, if you can understand duration, you will have a huge advantage in interviews because very few undergraduate students do. All right, so let's say, okay, interest rates are really low. Hopefully y'all can see this. The 10-year treasury. So we know the maturity is 10 years, right? So what is the duration? Remember, duration is the weighted time using what as weights? Using discounted cash flows as weights. All right, so the duration of a 10-year treasury, would it be 11 years, 9 years, or 7 years? What do you think? I'm not sure it's exactly one of those numbers, but it's much closer to one of those numbers than something else. Which one can we throw out immediately? Which one do you know is not the answer?
Could it be closer to 6? Because you said it was 0.6% interest right now.
Interest rates are low. So let's think about with low interest rates, $1,000 discounted in 10 years is going to be what? It's going to be much higher than if the rate was 5%. So if you're putting, if the 10th year cash flow, and you're using discounted cash flows as your weight, if the 10-year cash flow discount is going to be much, much larger with low rates, then you have much more weight on year 10. So what is that going to do to your duration? Will it make it higher or lower? If you put more weight on year 10 versus years 1, 2, and 3, you're going to end up with what? A higher number, right? So interest rates are lower. The 10th year, that out year, is going to have a higher discounted cash flow, so the 10th year will get much more weight. Because think about it, the 10th year is getting $1,000 because that's your principal coming back. All the other years, you're just getting the coupon. You should have seen that in 3013. We'll see this again later in the class. But, so interest rates are low, durations are much higher. So Sophia, it's going to be more closer to 9 or 11 than it's going to be 7. If interest rates got up to say 7, 8, 9%, that's when you get down to 7 or 6. So duration drops as interest rates rise. Now, one of these two numbers you can throw out immediately. Which of these can you definitely throw out? If we're taking a 6 months discounted cash flow multiplied by 0.5 and a 1 year by 1, and we're adding them all up to get that weighted average cash to maturity, which of these two can you kick out? You can definitely kick out 11 years. Why? It's impossible for duration to be longer than maturity, right? If duration is a weighted average time, maturity must always be shorter than maturity, because maturity is, if you only got one cash flow in 10 years, then your duration and your maturity will both be 10 years. But because you're getting other cash flows earlier, that's going to shorten down your duration, so it'll actually be lower than your maturity. This is beyond this class. It's a little extra, but if you take Dr. Baynot's fixed income class, which I recommend that you do, boy, this can help you a lot. It's real important on the CFA exam. If you take that exam, you got to understand the intuition of duration. I'll show you later in class how to calculate duration, and there's actually a web page I can send y'all. I might send it out with this week's email, where you can go out and do calculations of duration with different bonds and get some practice and get some intuition for how they work. But yeah, duration is the weighted average time to maturity, which means because of those coupons, duration will be shorter than maturity. But as interest rates fall, duration will get closer to maturity. All right. Convexity, have y'all gotten there yet? I can't remember exactly where I stopped on this this video. Did we talk duration this week's classes or not? I can't remember. Let's see, let me look at the video real quick. I know we may have started it. We might not have actually gotten that far. So class 3, the last thing, class 4, today's class.
What we want to do is get
the last thing we got to, yeah, I finished convexity in class 4, so you should have seen convexity. Is there anyone out there with the courage to talk convexity, or is that just too advanced for you right now? Have y'all heard convexity before? I don't think I taught convexity at all in the previous class. Anyone want to try to give a definition of convexity?
From my understanding, it's like comparing bond prices and the yields.
It definitely has to do with price and yield.
Mm-hmm.
So does duration, though. So how does convexity differ from duration? If you think in terms of calculus. Remember, in calculus, you have first derivatives and second derivatives. You take the first derivative of something, the second derivative. The first derivative is telling you kind of the peak point. The second derivative is telling you how much that's changing, the change and the change. So duration is like the first derivative of price versus yield, Convexity is that the change in a change. How does duration change as interest rates change? So convexity is that second order magnitude. And I gave you a formula in the notes that shows you how to use duration and convexity to figure out the impact on the price of a bond. I don't know if y'all remember that. Let me bring that up just so you can see it. I'll have to switch. It's down below. Let me switch over there real quick. Oh, I may not have given you that formula. I have to give you that formula. Why? I thought I gave you the formula. Oh, I didn't. Oh, wow. I have to give you the formula. Okay. All right. So there's a formula. And boy, I'm surprised it's not in my notes. So there's actually a formula you can use that tells you exactly the impact. I'm trying to find it in my notes because I could have sworn I gave it to you. That tells you how much a bond price should move based on convexity and duration. And I'll show you that file. Oh shoot. Oh man, I wish I had it in the notes. Sorry guys. So I've got a file that I created on duration and convexity, and I'll have to share it with you. And I could have sworn I put it out there. So let me switch to it, and I'll show it to you. I'm still not really fast on this. All right, can y'all see this? This is a file that I think I have it out there on Blackboard. It actually calculates duration and convexity. I can't remember if I put this into the YouTube. Does this look familiar from the YouTube video? Anybody? I might have done this on the YouTube, so I'll have to go back and look. But here's a 10-year treasury. So what are interest rates today? Like 0.006. And so Sophia, see how the duration jumps up to 9.7 years? See, there's duration on line 3. When I take the interest rate back to 6%, see how duration falls down to 7 years. So as interest rates fall, duration rises. And then here's convexity, and here's the formula over here. Do y'all see this formula over here? I would recommend you actually put this formula on your answer to question 1 on the exam. Some students actually in prior classes even memorize this for the exam, but this is the formula. I've already given you the first part of the formula. I know we talked through that. Minus duration times the change in yield. You should have seen that in the class 3. But then you add to that convexity times the change in yield squared divided by 2. And you'll notice with convexity, you're actually squaring it and dividing by 2. When you square a really small number, it gets really small, and then you divide it by 2. So convexity only has an impact on price when interest rates change a bunch. If interest rates don't change much, convexity has almost no impact. But when interest rates change a lot, convexity has a huge impact. And here's a chart I built that shows you that. The red line shows you how a bond price moves. Did y'all see this chart with the red, green, and blue? You can shake your heads. I see all. So that's what duration tells you. Convexity is this curved part. This is how bond prices actually move. So you notice if interest rates stay between 5 and 7%, the red line gives you a really good forecast of what the bond price will do as interest rates change. But you notice when interest rates change a bunch, this bond has a lot of positive convexity, and you should have gotten that in class 4, positive versus negative convexity. A lot of positive convexity. This blue line is the actual price of the bond changing. The green line is the line using that formula I just showed you. You can see it gets pretty close, but it's not perfectly accurate. And that's because duration's changing as rates change, but also convexity is changing as rates change. So everything's changing. So there's a third derivative of this whole thing, the change in convexity as interest rates change. So I've given you this chart. You might want to go out and experiment and play it some. And then I could have sworn in video for class 4, I think I showed you the student who gave you, and I think it's in the class notes. He built a website that does exactly what this Excel file does as well. So you can go in there and experiment. What's the duration of a 30-year bond? So if we have a 30-year bond, the duration for a 30-year bond is 26 years. But if interest rates are high, like 6%, the 30-year bond's duration is only 14 years. So you can see how sensitive a longer-term bond is. But look at the convexity of that 30-year bond. It's almost 900 versus a 10-year bond. The convexity is 100. So longer-term bonds have a lot more duration, have a lot more convexity. So it's a tough concept. I'm not asking you to be experts on this. I am hoping that you'll go out and actually do some Wikipedia searches and read on this. They will be amazed in an interview if you actually have any concept of understanding on these topics, because these are pretty advanced. But if you do take the fixed income class with Dr. Baynot, he'll go into this a lot more detail. He's a very quantitative person, but he's also a very good teacher as far as teaching hard stuff in a way that's understandable. So boy, I take his class. It would help you a lot, not just to get a job, but also on the CFA exam, because they do test this kind of stuff on the CFA exam. Questions on this? Tough stuff, right? Some of you are saying, I don't want this tough stuff, and that means you got the wrong major. Some of you are like, man, I'm sure glad you're covering this because I want to beat the competition. So it's kind of how you react to this tells you if you got the right degree or not. All right, so.
Just a quick question. Is Professor Tui still teaching the fixed income or not anymore?
He's not this semester. I don't know if he and Baynot are going to switch or not. Tui's a really good person to teach because he's a life actuary and their fixed income background is really strong. But Baynot's very, very strong too because he's obviously got a lot of quantitative background. So either one of them would be great to take that class. Haven't heard from anybody this semester taking Baynot and how it's going. I heard some good things from Tui's class last semester. The nice thing about Tui's class is he actually taught it in the Bloomberg lab. And fixed income on the Bloomberg machine is far more valuable than equities are. There's a lot of fixed income stuff. So yeah, try to take those classes if you can from either one of them. Other questions?
Sir?
Uh-huh.
So like, I guess since I'm new to this class, we can take notes while you're
oh yeah,
speaking.
you should be, yeah. Yeah, take notes while I'm talking, definitely. You can take notes inside the notes themselves. In fact, you know, for participation, class participation, you can send me your notes at the end of the semester to show that you were engaged. So you definitely want to be doing that. Yeah. And Diego, since you just came in, you probably haven't watched the videos of the class yet. So, and I'm getting impressions some people haven't watched class 4 yet. So you definitely want everybody to get caught up on that. All right. So you've got duration, convexity. Convexity is the hardest thing on exam 1. So I'm sorry, Diego.
Oh, so like I was gonna ask, the videos are on Blackboard, right? There are 4 classes that you have.
If you look on Blackboard, there's an announcement.
Convexity.
And my announcement, the last announcement I sent out, had the link to the videos. The videos of today's class, the video of the live sessions are out there on YouTube as well. So I have them on YouTube under a I forget what it's called. I don't know why I can't remember that term, but they're all together. Actually, Jose Luis's and Sophia's class and the
It's
others.
a playlist.
They
Like a
recommend
playlist. Yeah.
and so they're all together so you can see them. And this session will be out there as well. So yeah, so the key is engagement. So don't just watch the video and then stop. Go out and Google, Wikipedia, get yourself exposed to these topics. These are extremely important topics. They're complex, and we're not even scratching the topic. I mean, it's just, there's so much more you can learn on this, and you'll quickly see why you can make so much money on fixed income, because it is the quantitative side of finance. All right, I got someone on the chat for some reason. Okay. All right, let's talk real quickly about tomorrow. I don't want to go much past 30 minutes here, but let me ask you a quiz on tomorrow, so we'll see how that goes. So let me ask you a couple of questions here, and y'all can answer it. I'll give you a couple of seconds to answer it. So today's stock market, the S&P, here it is. This isn't as of close. I don't know how it closed today. I should go back and look. Let's see how it happened. Somehow I got shut out of my Google. So it
It dropped 3.5% today.
3.5. So it came back a little bit from the close. So hopefully y'all can all see this. So the best way to describe, so this is, look at this because it came back from 3.9 to 3.4. So the best way to describe the S&P, I'm going to add one more thing. All right, no, I'll keep it like it is. So what did the S&P do? It fell 140 basis points, which was 392 basis points, which is a normal drop. Fell 3.92% or 140 points, normal drop. Fell 140 points, 392 basis points, which is a dramatic drop. Fell 392, 140 points, which is a dramatic drop. Which of these, if you said it, they would not look at you funny at interview, and the other three, they would look at you funny if you said them.
Would it be D?
E. Yes.
I got one vote for D,
D.
2 votes for D. Anybody want to argue for another one?
Say B.
It's D,
Which one?
sir.
Anybody want to vote for C?
Yeah.
All right.
Like,
So,
I'll say B as in boy. I don't know.
boy, okay. So you're in the normal. Okay, so let's talk about the normal drop. What did I say on the normal drop? A 1 sigma event was what? Anybody remember?
1%.
It's about 1%. So what was today?
Almost 4%.
Almost four sigmas. Not 4. Yeah, almost 4%. So almost 4 sigma event. How often does a 4 sigma event happen? Like once every 1,000 years or so, or something. I don't know. I'd have to actually calculate it. Let's see. Equal norms dist 4. It happens. It happens like once every 100 years. Now I know it happens more often than that, but the markets have fatter tails than what the statistics say. So can you say this is a normal drop or dramatic drop?
And I have one of 4.
Dramatic.
Definitely dramatic. Definitely dramatic, right? So if you go in the interview and say, yeah, the market was down a little today, they're going to look at you like, what? It was down 3.5%. What are you talking about? It's a dramatic drop. So anything more than 1% is a pretty good market. More than 2, you're talking about a 2 sigma event. Go back to your stats class and think about 1 sigma event, 2 sigma event. 3, you're really getting rare. 4, you're getting very rare. 5, 6, 7, that almost never happen. So this is a 1 in a 100-year event. And I mean 1 in a 100-year, 1 day out of 100 years, you would expect to see something like this. That's pretty dramatic. All right. C is not necessarily wrong, but why would they look at you funny? We don't talk about basis points when we're talking about the stock market. Remember the stock market, the S&P is not a percent, it's an index, 3,440. When you're talking about the change in something that's not an interest rate, you can just talk about the percentage change. There's no reason to talk basis points. So the S&P fell 3.92% or 140 points. I do have some students that make the mistake of saying the S&P fell 3.92% or 140 basis points. But no, this is not basis points. That's 140 points. So be real careful with the term basis points. Only use basis points when you're talking about the change in something that's already a percentage. You'll see that on paper 2 as well when you're talking about the change in gross margin and net margins. Gross margins and net margins are percentages. So if the gross margin goes from 40% to 41%, you can say their gross margin's up 100 basis points. So when you're talking about a change in a percent, use basis points. When you're talking about the change in something that's not a percent, just say the percentage change, okay? Questions on that? We'll see how it goes tomorrow. I was kind of hoping today's market would happen tomorrow so you'd have more to write about. We'll see. We could get a wild market tomorrow. How did the jobless claims come out today? Anybody see them? Over 1 million, less than 1 million?
Less than $1 million.
Less than $1 million. So that's good, right? After last week, they jumped up, so we're back down again. That could have some impact. There's a really good article today on Yahoo Finance about employment and employment reports that you might want to read that. It was very, very good. I might give you a link to that in the email tomorrow. Yeah, tomorrow morning, somewhere around 8:30, the job report will come out, and you want to be paying attention, collecting articles, and then getting the market, how the market does. All right, let's see. Don't answer the question yet. Y'all write down your answer and give me a few seconds. So the best way to describe the 10-year Treasury today, I don't know how it actually ended today, but we can look real quickly and see. I'll look over there. Yeah, it's exactly this. So it didn't change any in the last few minutes. So its price fell as yields rose 2.9 basis points. Its price fell 4.45%. Its price rose as yields fell 2.9 basis points. Its price rose as yields fell 4.45%. So don't say anything, write it down, click out the ones that don't make sense. If you missed class 2, then you'll have to catch up on the discussion on this. I'll give you 10 more seconds. All right, anybody want courage to give an answer?
C.
See? Any other arguments? Any other? So number 1 is definitely wrong because yields fell. That's what this thing right here is, the 2.9, 0.029, that's the yield. All right, we still got people coming in, or maybe they left and they come back in. So, all right. Do y'all see that this is 2.9 basis points?
So would C and D be the right answer? Both?
All right, so D is not incorrect, but it's really weird. And the reason it's weird is this 0.62% is a percent. And to talk about the percentage change in percent is really confusing. And so because 0.62% is a percent, instead of saying the yield is down 4.45%, your boss would say, okay, what are you saying? They're asking, did it change 4.45% or was it 5.1% yesterday and now it's 0.6% today? It's really confusing. But if you tell your boss the 10-year Treasury is down 2.9 basis points, they will know exactly what you mean. There will be no confusion in that at all, right? So anytime you're talking about a change in a percent, use basis points. 100 basis points would be this first number here. If it was minus 1 point something, that's 100 basis points. The next one is the 10 basis points, and then 2, 3, 4 basis points. So this is 2.9 basis points. Now, is this a huge day or a small day? Anybody remember what one standard deviation was on the yield change?
I think it was 4.6 basis points.
Close. Switch those two numbers.
6.4.
6.5 basis points. So 6.5. So what is today? Today's a fairly normal market, not that huge. So if you see interest rates change by more than 6 or 7 basis points, that's a pretty big day. We might see that tomorrow. The employment report can often get you big changes in interest rates. The Fed saying something can definitely cause huge changes. Remember I showed y'all this year, we saw some massive days where we saw some days where yields changed 27 basis points. In fact, we had 2 days in a row. Can you believe that? 2 days in a row where yields changed 27 basis points. That's a huge day, right? If 6.5 is one standard deviation, then 27 is a huge day. You don't want to walk into an interview on a day when interest rates are changing 20 basis points and you don't know that's going on. That would be really embarrassing. So today, yeah, interest rates are down 2.9 basis points. Bond prices rose slightly. So C would be your answer on this one. All right, so see if you can figure that out tomorrow morning. So one thing you probably want to do, and I'll help you with this, is you don't want to just say what the markets do tomorrow at the end of the day. You also want to see what they do initially when the report first comes out, and I'll give you all some charts that will help you with that. Because when you're telling your boss what went on, you want to say what was the initial reaction, and then how the market decide as the day moved on throughout the day. And I'll put some charts out there. I do some FinViz charts. One thing I'll warn you, the FinViz charts that I'll give you shows the 10-year Treasury price, not the 10-year Treasury yield. I'll try to get you a 10-year Treasury yield chart, but it does price. But you don't talk price. We don't talk prices. It's really strange in finance. You don't tell your boss the 10-year Treasury bond is down 0.2%, the price. We don't talk about the price. We only talk about the yield. We just say the price rose slightly or is up a little bit, and we talk about how much the yield changed. Very different than the stock market. The stock market, we say, hey, the stock market was down in price 3.9%. But we say the 10-year Treasury is down in yield 2.9 basis points. And I'm very picky about that on paper one, so if you're not sure about it, type it up and send it to me, and I'll let you know if you got it on track. Because a lot of students lose a lot of points on the bond side. All right, so that's all I want to do today. Make sure you're getting duration and convexity, and then make sure you're ready for the paper tomorrow. Now, I'll seek y'all's feedback on how you want to do these Zoom sessions. If you want one a week or one every couple of weeks or something, I do want to touch base with you every once in a while, just because I'm worried some students are not engaged. And so we'll see. You can give me feedback and let me know. I will put the recording out there, so if you can't make it at that time, that's understandable. But if no one's showing up, I'm not just going to talk to myself either of those. So we'll see. But I do want to stay engaged. I don't like this that I don't see y'all every week. It kind of bugs me. I've had some email me. I've had some call me with questions on the class. I love that. That gives you points for participation. So if you're not figuring out convexity, call me tomorrow morning. I'll be on my bike. Well, you call me on convexity and make my bike ride feel like 20 minutes. It goes 3 hours. But if you want to talk 3 hours on convexity, I won't even notice I'm on a bike because I'll be so enthusiastic talking about convexity. So you're free to call me on these topics. Don't sit there and stew because you're not understanding it. You know, call me, look it up on Wikipedia, try to get these terms down. Your goal is to permanently learn this stuff. So find ways to get it into your permanent memory. Okay,
So we are meeting tomorrow.
Tomorrow you have the employment report coming out, which is your paper one. So tomorrow morning around 8:30, it comes out right before market open. It might come out, I get my time zones mixed up. I can't remember if it comes out 8:30 New York time and then the market opens at 9:30. If it comes out 8:30 San Antonio time right before the market opens. I can't remember which of those two it does. But you have a paper due in a few weeks on tomorrow's employment report. And you're going to write about it entirely about tomorrow. I know ISM came out this week. If you want to talk about the ISM, it came out very strong this week. Make sure you set it up well in your paper because your boss didn't ask you to talk about ISM. So if you want to talk about ISM, the way you set it up is just add a little bit more color to this week. The ISM also came out this week and it blah, blah, blah. It confirmed that the markets are getting better, the economy is recovering, whatever. If you want to talk about the jobless claims yesterday, you can say, wow, we got a strong employment report. Is somewhat expected because Thursday's jobless claims came in better than expected and below. But make sure if you talk about something that's not the jobs report, that you say why you're putting it in your paper because your boss only asked you to talk about the jobs report and the unemployment rate. You do get extra points if you talk about other things, but you got to set it up correctly. Don't just start talking about the ISM without saying why you're putting it in your paper. So I usually put those things in there as to say, I want to give you more color for the week, what's going on this week. And so, you know, this report is in line with what we saw on Wednesday with the ISM report, and you give a quick synopsis of the ISM report, something like that.
All right, so by tomorrow, we should have an employment report.
Right, and I'll be sending
I
you
guess
stuff out.
add the ISM.
Well, the ISM came out on Wednesday. You don't have to talk about the ISM, but there's 10% of the paper is other things that you talk about. So you got to find something else to talk about besides just the things that are in the rubric. So ISM is one possibility. The jobless claims, one possibility. Other markets like the US dollar or gold or small cap stocks. There's other possibilities. You have to talk about the S&P 500. You have to talk about the 10-year Treasury, but you can talk about other things that are going on around the world. Hopefully we'll have a big report tomorrow and it will just absolutely blow the whole world away, and you have plenty of things to talk about. Your best bet is to get up tomorrow morning and start looking for articles on Yahoo Finance, on MarketWatch, on Bloomberg. All the articles, you will see a bunch of articles come out right after that thing hits. And I would just collect them and put them on a place so you can just read through them. They won't be really long, but read through them. The best places like Bloomberg.com, they're good because all they do is finance, and so they tend to be more sophisticated. You'll see articles on CNN and other places, but they tend to be a little skewed in their outlook. Obviously, this is an important report for the election because we'll only get one or two more before the election, and so this is setting up. Are we recovering, or is the fact that unemployment, the $600 went away, or the fact that we're getting a resurgence in the COVID-19? What kind of impact is that having? So these are important reports. My guess is tomorrow's will be pretty important and will move markets. You can go out to the economic calendars and see what the markets are expecting. So you can do that today and they'll show you what's expected. And that can help you. If you don't have a clue what this is all about, you never looked at this before, it doesn't matter, because tomorrow you'll see 6 or 7 or 8 articles, and after you read them, you'll have it all figured out. This is very easy stuff to teach yourself. This is not real quantitative advanced. It's fairly straightforward stuff. And so the articles will tell you exactly what to look for, what to assess, why markets are doing what they're doing. So if you're like, man, I don't know what he's talking about, you will tomorrow when you read and see what's going on. All right, anything else?
Sir, do you have any idea why the market moved so much today?
Yeah, today's a tough one. The articles are saying market's down just because they've been up so much the last few days. I don't know if anybody really knows that. Today was a...
They mentioned the tech shares, but I don't.
Yep.
I mean, I don't think it's it's not only because of that, of course. So
Did someone report earnings today, or did something come out? Jobless claim was good news, so it wouldn't have been that. The 10-year Treasury is not reacting that much, so this could
that's
have
why
been technical.
that's why I'm surprised that the jobs were better, and still it just dropped so much.
Sometimes it's a technical thing, so you might look at your 200-day moving average, your 50-day moving average, and see if there's some cross happening. It is a very shallow market, so Apple or Microsoft or some of the big players, if they move, everything else is going to move just because they're so dominant right now. Yeah, it's hard to say. I mean, the people writing the articles, they don't know either, just making stuff up. I've always wanted to write those articles and just make up stuff. I remember a few years ago, I saw an article that said the market is down today because, and a few hours later, the market had come back. And the article title was exactly the same. They just changed the word down to up. The exact same rationale. So they don't know. They're making stuff up. No, there's no one out there saying the market moved because of this, because there's millions of people trading. There's billions of shares trading. They're trading for all different reasons. There doesn't have to be one reason, and it can be technical. Maybe it broke down 1% and that hit some technical level, and then once they hit that technical level, the day traders push it down further, and then suddenly everybody's moving.
Yeah.
Down. And you got to remember, on any given day, only 4 or 5% of the people that own shares are actually trading. So 95% of the world didn't do anything today. So they don't care. So it's hard to say that. But tomorrow, usually the employment report will have some impact on markets. So hopefully tomorrow will be a big impact.
Mm-hmm.
Following up on that question, Professor Sweet, do you think that if the report, even if it's not like very bad tomorrow, do you think since the market was taking such a hit today, it would respond even worse tomorrow?
Well, I don't forecast anymore. These things shock me.
Yeah.
So, the good news is bad news argument, I think, is weak right now because I think the Fed has signaled they're not raising rates anytime soon. So in the past, good news is bad news because the Fed's going to raise rates. I think that's done for. They're not going to raise. Everybody's talking about the mistake they made raising rates before, and having to come back down. So that's not it. So I don't see it good news as bad news. The Fed actually says they want to see some inflation, so I don't think that's it. I don't know if the market's pricing in a Biden or a Trump win. My guess is they're starting to price in a Biden win. But in 2016, they were pricing in a Hillary win. And everybody said if Trump wins, the markets are going to crash. And Trump won, and the market shot up. So it's almost impossible to predict these things. I would guess they're happy. I think they're worried that things may be deteriorating. So I think good news will probably be good news, and they'll rally. But boy, don't quote me on that.
Yeah. Okay. Thank you.
But that's your job. You know, it's, to me, it's pretty good. I'd actually be excited if we got a good report tomorrow and the market sold off 3%. I think that's more fun to write about, because then you're a detective and you got to figure out why did this happen. It's kind of boring. You got a good jobs report and the market's up 1%. That's kind of boring to write about. So hopefully we'll get something exciting tomorrow. Now, generally the stock market and bond market move in opposite directions. So when stocks are up, usually yields are up, so bond market is down. So one little trick I'll tell you. So if you get good news, usually the stock market's up and bonds are down because yields are up. If you get bad news, stock market's down, the 10-year treasury's up as the yields are down. When did stock market and bond market moves together? They move together based on inflation. When inflation is the story, the stocks and bonds will move together. So a few years ago, we actually had an employment report for this class where the biggest number in the report was pay inflation. And so both the stock and the bond market sold off because inflation was the biggest part of the news. So generally you'll see one, so like today, you're seeing the bond market's up and the stock market's down. That's the most normal. So if tomorrow you see them both moving up or both moving down, inflation might be the thing to look for. Look at the pay raise and see what's going on there. I doubt that's going to be the case. I think it's likely they'll probably move in opposite directions tomorrow.
So on paper one, would it be redundant to reference both the unemployment rate and the labor participation rate? Or do they differ enough that the data is significant?
No, talk about all the pieces of it. So the jobs report is jobs, but it also shows you by industry. You don't want to talk about all the industries because that's, it's wasteful information. But if there's one industry that moved a bunch, you might want to focus on that one. On the unemployment report, the participation rate's really critical, actually. It's possible that unemployment can rise just because more people are coming back to the labor force. And the market will actually interpret that as good news. The reason unemployment rate is higher because more people said they were looking for jobs because they're more excited about the job market coming back. So yeah, you definitely want to talk about the participation rate. You want to talk about the inflation in the pay, if that's possible, if that's a big number. Don't talk about something if it's not material, but look at everything in the report. If you go to the Department of Labor site, they'll give you all the details and you can read through that. Reading articles will tell you. So if you're reading an article, if participation rate's important, they're going to talk about it. So let those articles help you know what's important, what to focus in on. I have some students that just dump tables of 50 pieces of data. Don't do that. If you're going to do that, then highlight what you think is important. You don't want your boss to have to look at 50 numbers and figure out, why did you give me this? Okay, so education, they laid off 400 people. Why is that important? Why would I care about that? Look at everything in the reports. There's several pieces of data in those reports and figure out what's important. You definitely have to talk about the number of jobs. You definitely have to talk about the unemployment rate. You'll probably talk about the participation rate. And you'll probably talk about some of the sectors in the economy that are moving, but I can't tell you what you'll talk about until the report actually comes out. Other questions? All right, so if you've never done this before, this is gonna be good practice. Good chance you'll see something like this in your first job, so start getting used to it. And don't write off the top of your head, go read articles. Go see what the experts are saying. All right, nothing else? Very good. I'll sit around for a couple minutes. I'm sorry?
You said that this will be recorded as well, correct?
Yeah, I'll put this out on YouTube.
Thank you.
Anything else? All right, get off anytime you want to. I'll stay around just in case someone has a follow-up question.
Thank you, sir.
Thanks.
Professor Sweet, this is kind of just a generic question, but in terms of like texting you or calling you, what are like your preferred times for a student?
Any time is fine, Monday through Friday, except for Tuesdays, Thursdays. I have a class at 7:30, and then Friday I have a class at 1 o'clock. But other than that, I'm free. You might get my voicemail, and I'll call you back. The mornings are great because that's when I'm on a bike. I mean, unless you need me to actually look at something online, I can talk easily on my bike. It's no problem. I might sound like I'm out of breath, but that's just because I'm old and on a bike. But yeah, I can talk.
Okay. Okay, that sounds good. Thank you.
Sure. All right.
What time do you normally do the bike?
I'm usually out there definitely by 8. It's 3 hours every day, so from 7 to 10 or 8 to 11 kind of thing usually. 10 o'clock, I think 100% of the time I'm out there 10 o'clock. Now tomorrow it might rain. If it's raining, I'll ride in the evening instead of in the morning. But then I'll be at home and I can answer the phone just as well. So it's not that big a deal.
Professor, I do have a question as well.
Okay.
Or not really a question, more like of a sort of, I guess it makes sense. Like when you mentioned about you wanting to have a lecture once a week and you wanted us to give you feedback on it, I do think, in my preference, having one lecture a week, I would say like have a day off on Tuesday and then your lecture on Thursday. Kind of one day for the project research, one day for you to give like a lecture and feedback, kind of like how today is.
Yeah, so I was going to keep the lectures on YouTube, but then let this be questions and answers and go into things. I was thinking 30 minutes. This one's going a little longer, but yeah. We'll see. I mean, I'll make it optional, and if only 2 people show up, then I'll stop doing them. So essentially the class will define whether or not we keep doing them or not.
Okay.
Yeah, I'm fine with that. Yeah. And 3 o'clock, you know, 3 o'clock works really well for me, and then we go 30 minutes, you know, it kind of ends with the class normally would have ended.
Great. Thank you.
Sure. Anything else? All right, and Diego,
So,
if you need
may I ask-
anything, I'm sorry, go ahead.
So, like, may I ask, like, just, I guess, a regular question? You said, like, since I'm new to the class, so, like, like, I guess, or unemployment report that would be due tomorrow.
No, you
Right.
look on the syllabus when the due date is. What I told the class
Oh, okay.
last Thursday is in a job, you would actually publish this 9 a.m. tomorrow morning and hand it to your boss. I'm giving you several weeks to do it. So you're going to do something you would normally do in an hour or less, but I'm giving you weeks to do it because it's your first time to try it. So,
Oh, okay. All right. So, like, we don't have to turn in nothing tomorrow, or like a.
no, actually the due date, I forget when the due date is, but you'll actually have to have a draft ready the week before that because we're going to actually grade your papers in a Zoom session in smaller groups. And then it'll be
Okay.
next week. So you actually need your first draft a week before it's due. And I don't remember when it's due. I'd have to look at the syllabus. But let's say it's due September 24th and you need to have your draft September 17th. And I'll have smaller groups of about 7 or 8 students and we'll actually grade each other's papers and I'll walk you through the rubric. And then you'll know if you have something major missing on your paper. But yeah, you'll have to have it tomorrow. But if I were you, I would write it tomorrow because that's when all the information is going to be there. It's going to be a lot easier to write it tomorrow than it is a week from now.
And at what time does the information comes out? At 8:30 or 9?
That I can't remember time zone. I can't remember if it's 8:30 New York time or 8:30 San Antonio time. So we'll see tomorrow. I think it's 8:30 New York time, and then the market's open at 9:30. But I always get confused on that. It seems like it comes out about an hour before markets open, but there's some of them that come out right before markets are open, and some of them that come out an hour before, and I get confused. It's one report though, both the jobs report and the unemployment, they both come out together. So it's all one big report from the Department of Labor. All of that, every single thing is all one big report. If you go to the Department of Labor's website, there's plenty of stuff there. You can start reading up on it now, and they probably tell you when it's coming out tomorrow. Just Google Department of Labor and maybe even jobs report, and you'll get some sites that go right to where you need to go.
And Diego, it's October 2nd is the due date.
Yeah.
Oh, that's when the, like, that's for the draft of the whole paper? Or?
No, October is when it's due, October 2nd. So September 24th or sometime is when you have to have your first draft ready.
Okay, all right.
So you got a month to finalize it, and you've got 3 weeks to get your first draft. And you can send me your first draft anytime you want to before that, so you don't have to wait until we do it as a class.
Then I guess like I haven't been able to read the information.
Hey, your microphone's breaking up, Diego. I don't know what's happening to your mic.
Oh.
I hear half your words.
So do you hear me now, or?
It's breaking up, but try it. I'll see if I can.
So like I wanted to know on our paper or on our draft, we have a different sections, right? And for instance, one of them is the jobs and unemployment section.
Students organize it differently. There's 3 example papers out there on Blackboard. What most students do is they talk about the jobs report first, the unemployment next, but they kind of do it all in one big section. And then they might add something else like jobless claims or ISM as just extra color. And then they get into the market's reaction. That's the normal approach. But look at some of the student examples and you'll see how some of them approach it. One thing I said, make sure you don't copy and paste the student example. I had students do that last semester, and I'll definitely count off a lot on that. So write it freehand. Some students said, I'll just copy and paste what someone did last semester and I'll just edit it for this report. You definitely don't want to do that. Then you'll get a lot of plagiarism overlap. Yeah, there's actually 3 papers out there. I think one of them's in Word. If you want to use that format, I really like the format that students have been using, the 2 columns, and just looks a lot more professional. And Word actually has that as one of its options. So if you want to select that option, it looks very, very professional.
So when we peer grade our papers like the week before the actual due date, it's just like for our own benefit to have like to grade each other's papers?
It can impact your participation. So if someone's not ready or they don't show up, it can be a serious impact on participation. Remember, participation is anywhere from a 2% bonus to 5% deduct. So it's important from that standpoint. So you need to have a good, but I don't collect that grade as part of the paper grade. And I'll give y'all more information on that, a week or 2 out, exactly what we need. All right. Anything else?
Oh, and then so where on Blackboard do we find the student examples?
So right before Blackboard, where it says the live session, there's something that says content. So click on content.
Yep.
And then there's all those directories. You just click on the right directory. There's a directory for the papers, and then you click on that. For paper 1, you'll see the student examples. There aren't student examples for the other papers, and there won't be. So I want to give you examples for this first paper.